Hey guys, I hope everybody's doing good today. Sorry I couldn't make it. I had a scheduling issue. I actually had to work a double at my job, and I completely forgot about it. So I can't make this week's Zoom call, but I did record this quick 20-minute video just so you guys can take a look and see what I was going to go over. I wanted to talk about price action and just general market movement. Um, so I'm going to just jump into it and kind of go over everything. So, first thing I want everyone to understand is that the market moves based on psychology. So, if you think about all of the traders in the market at a time, whatever they're trained to do is generally what the market will do. So, take you have strategy A. We'll say it's the bounce back. So you have the bounce back strategy, and then you have, say, the harmonic scanner. We'll go with those two. So the harmonic scanner trades based off of pairs and Fibonacci sequence. So it goes off of, I mean, not pairs, patterns and Fibonacci sequence. So there's patterns such as the ABCD pattern, the Gartley, the butterfly, bat, the bat, so on and so forth. Well, they all follow. Those patterns require a certain mathematical equation for them to yield true or false. Like they have to meet certain requirements in order for them to be a legitimate pattern. So we'll say that there's 500 traders in the market that know the bounce back strategy, and then there's 1,000 traders in the market that know how to trade on patterns. Okay, so as markets moving, as the price is moving, traders are going to buy and sell based on their strategy. Okay, so if you have 1,000 traders that are trading based off of patterns, then they're going to hold the market because there's more of those traders than there are, say, bounce back traders. So everything that happens in the market is going to happen based on whatever they do because they're the majority. Okay, now say we flip that and there was 1,000 bounce back traders versus say 500 like pattern traders, then everything that you see in the market is going to like happen based off of the bounce back strategy because that's what there is in the market. Now there's just thousands of strategies out there, even 10 times that traders, and everybody's trained differently and sees the market differently, so the market's going to move based on whatever the majority is. But basically, when you know the psychology of it, then you can kind of break it down from there. So before we even look at a chart, um, know that you're going into an analysis knowing that um, that somewhere there's a majority share of traders and what strategy they know. Now, when you know that, you can kind of base your analysis around that, and also come to the realization that every trade is going to be different. Say like at three right now, it's for example, it's 3 in the morning, and there is 500 traders of X strategy and 1,000 traders of Y strategy. Okay, and then in an hour or two, we'll say 2 hours, when the London set or when the New York session opens up, then a lot of traders are going to be making their way out of the market right now, and then new traders will be making their way into the market. There's probably new traders already in the market right now, and they're always going in and out. There's always new traders coming in, new traders leaving, so on and so forth. So as traders fluctuate, strategies fluctuate, and price fluctuates. So no two trades can be identical. You can't correlate one trade to another. As human beings, we do this. We correlate one experience with another. This is very popular in a book called Trading in the Zone. If you, I highly recommend reading the book Trading in the Zone by Mark Douglas. So if you take a dog, for example, and a baby. So a baby sees a dog for the first time. Um, the dog barks and scares the baby. Okay, so from then on, because of that experience, the baby's always going to think, well, dogs are bad because this dog barked at me and scared me. I'm afraid of dogs now. Okay, so nothing. So in order for that baby to think otherwise, it needs to have another experience that's equal to or greater in impact that can change the baby's mind. So say the next time around it sees another dog, now the kid's afraid because the kid had a bad experience the first time. But say the second time the dog doesn't do anything, it doesn't bark, doesn't try to come up to it, it just ignores the kid. Okay, so then the kid's like, oh well, maybe dogs aren't bad. I had a bad experience with one, but then the next one wasn't that bad. So then say it happens again, and the next dog um, decides to come up and play with the kid and wag its tail and be playful and be all happy. Okay, so now the kid's like, wait, I've had a good experience and I've had a bad experience. Maybe not all dogs are bad. Okay, so we do this as humans. We always correlate one experience with another based on our past. Okay, so whenever we go to look at something, we think, hey, well, this happened before, so the possibility of this happening is pretty high. But in the market, it's not like that. You can't correlate one trade to another because I could see one trade and be like, hey, well, this setup happened last time and I made some profit, so this time I'm going to double down. But then all of a sudden, wait, it goes against you and you get stopped out or you get margin called because you doubled down and now you're out and you're like, what happened? I thought last time it worked, so why didn't it work this time? Well, it's because of that. So it's super important to understand that there's always traders. There's always a changing of traders in the market, and a changing of strategies. So you can't correlate any two trades together. You always have to look at a trade as if it was brand new, like it was like as if had just entered the market and it's your first trade. So now going into price action, um, right now I have GBP JPY. This is the German pound versus the sterling versus the Japanese yen. This pair in particular is very volatile. It moves a lot. I like to use it for teaching purposes, and I like to trade on it too. It's one of my personal favorite pairs. Anything ending in JPY is actually kind of my favorite, whether it's USD, Euro, or GBP, or AUD, so on and so forth. So anywho, so when you're going to look at analysis, you want to look at your time frame and decide what kind of the length of a trade you want to do. So right now, for example, I have it set to 1 hour. So every candle here is 1 hour of time. So in this case, we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So from this point to this point was 13 hours. Okay. Now we can change that to 2, 3, 4, 1 day, 1 week, 1 month, or even down to the 1 minute, 3 minutes, 5 minutes, 15s, whatever. Okay. So when you're doing your analysis, you want to make sure that you're understanding what time frame you're on and what type of trade you want to do, so that you can do your analysis based on that trade. Okay, so in this particular set, say we're going to do, we'll say we don't want to do a long trade, we want to do something shorter. So we're going to do like a maybe 2 to 3 hour trade. Okay, so you always want to start off on the day or the week. Some people do week and then go down to the day. It's strictly up to you and what you want to do. So we'll start with the day. Totally my bad. Let me get rid of this really quick. Actually, okay. So when you click on the day, it auto defaults to a specific time frame. So in this case, let's see, it's going back from current time frame all the way back to July of 2018. So the last 6 months. That's fine, we can do that. So this gives us the last 6 months worth of time frame. So 52 weeks, or 26 weeks. The first thing you want to do is do your support and resistance. So when you say support is basically when a price bottoms out like this. When you see that it finds a level that it stops at, so in this case it's right here, that's the support. It found support at this price and then it pushed back up. Resistance is when it hits the ceiling And like here, where it hit this point and then it couldn't break past that point, you can see that it tried multiple times and it didn't succeed. So that's the ceiling or the resistance. So you have your support and resistance. Any support can be a resistance, and any resistance can be a support. When I say that, what I mean is that, take this point for example. So this is, we'll do horizontal line, place it right there. So right here, price broke through the line, it went all the way up, it hit a resistance, and then it came back down, and then it hit here and it found some support. So it went back up. So it didn't break this line, but then it broke back down past the line, and then it came back up and it hit the line and it couldn't break past it again, and it came back down. So in this instance, it's support, but in this instance, it's resistance. So any line can be one or the other. So what your job is to do is to grab the horizontal line and try to set all the points that you see where this is happening. And what I do is I look at 2 points, 2 points creates, and then 3 points confirms. And you want to try to choose the points where it's the tip of the candle. I always use the body. So in this case, like, well, I use the body and the wick. It just depends on where it's at. Like in this case, I'd place one right there because that's kind of close to the edge. That's 3 points right there. So you can even lower it. I'll do the last 6 months. So there's 1, 2, 3, and then 1, 2. That's not really a third because it was just shy of it, but I'll leave it there. There's 1, 2, 3. This one was 1, 2, 3, even 4. And then 1. You can see it kind of stayed stagnant a little bit right there, and then now it's hitting it again. And then our very bottom. So once you have set your lines down of support and resistance, so that this tells you basically where the major price points are as to where price is reversing. And you can see that it actually breaks into channels. So in this case, it tried to break into this bracket, and then it got pushed back down, and it stayed in the second bracket. And then it got pushed back down all the way down here, and it stayed in this bracket for a little bit, and then it broke, and it kind of played on this line, jumped up, and then it stayed in this bracket for a while, came back down, up, stayed in this one. So you can see that it kind of chills in specific brackets whenever it gets to a certain point. So right now we've hit this line and it looks like there was a drop. So there's a chance that it could either continue dropping and this is just a pullback, or it was a full reversal and then the price hit this point and it's just finding a little bit of trouble trying to break that line, but eventually it will, kind of like right here where it's like on its way up and then it got pushed back down a little bit, but then it finally broke out. So once you've set these lines, the next thing to do is to set your trend lines. So your trend lines are going to be the horizontal lines, and you start at the highest point or the lowest point. So in this case, like if you're looking at this trend, you start right here, and then you're looking for 3 candles. It's the same thing. 2 candles create, 3 confirms. So you're going to connect the tips of 2 to 3 candles. So in this case, it'd be these 2. You can see where price came down, it hit right there, and that was the low, and then it started to come back up, and it came back down, it tapped the line, and then it shot up, and then here, instead of it tapping the line and continuing the trend, it broke the line, and then it started to come down. So this would be considered starting a new trend. So in this case, we go here, and we're going to repeat the process. So now you can see that it trended up and then it's trending down. So when you're trending up, I always put the line on the bottom because it's uptrending. So you don't really want to put a ceiling on it, even though technically I could, because these 2 points look pretty flush. I could just do something like that. But typically this top line, I don't really like to put it unless it looks more consistent. Like this right here, this looks pretty solid in terms of, actually it even doesn't. That was way too high. So my point for the 2 lines, basically what I'm trying to get at is that price can get into channels where it's hitting a specific top and a specific bottom constantly, and it'll do this consistently where it'll be like it'll hit this line and then come up and hit that line, then come down and hit this line, then come up and hit that line again, then come down and up and up and up, down and up, down and up, down and up, where it just stays in this channel. When it gets into a channel like that, it basically makes price pretty predictable. Like in this, I mean, in this case, even if you looked at this, you'd enter a sell right there, and then you'd watch it till it hit this line, and then you'd basically like close out right here, wait for it to come back up to this line, and then do another sell, and then wait for it to come back up to this line, and then do another sell, and then so on and so forth. You never want to trade against the trend. You always want to trade with the trend. So in this case, where it peaked out and now it's on its way down, I'm going to trade downwards, because if I trade down, you can see this was a big drop. Okay, but here, this wasn't really a super big up. It was kind of more consolidated, more horizontal than it was upwards. So if I were to trade this, then I would get a couple pips, like I would get a couple movements, but then all of a sudden it would start coming down again. So if I didn't get out of the trade right here, no, like basically you would get out where the line is at. But even if this came straight across and hit the line, then I'm making no profit. Even if I got out right there, that's no profit compared to this or compared to this. So I wouldn't even try to get in this trade. I wouldn't risk it, because you could not, if you don't get out in time, then you're gonna go down and lose all your profits, and then you'll be in the negative. So you always want to trade with the trend. Same thing here. You ride this up, wait for it to come down, ride it back up, wait for it to come down, ride it back up, and continue that. As a beginner trader, that you want to do that. Later, you can get into like the Fibonacci and knowing how much of a pullback will be a pullback, and then riding those if you want to. But you always want to mostly trade with the trend. Even experienced traders only tend to trade with the trend. And that's what these lines are. It's basically this trend, basically where price is going. So to determine a trend, we'll take this low point, for example. So this will be the lowest low. Okay, so that's just the low. From there, you have your first high. Okay, so here's your low, here's your high. Next, you have your higher low. And the reason it's a higher low is because this price is high, this stop is higher than this stop. Okay, so it's a higher low. And then you have a higher high, which is higher than this one. Okay, and then this kind of stayed horizontal for a little bit. You can call this a low. Technically it's a low, and it's still higher than the previous one. So at this point, it hasn't broken market structure. Market structure is basically the movement, the trend. Okay, so it hasn't broken the trend yet. Here, it hit this high, and it was equal to the previous high. So this is not a higher high. This is the same. So now we've broken structure, because now we're equal to what we were. Okay. Now we come down, and you can see that this low is definitely lower than this previous low. So now we're on a downtrend. Okay. So then this high is equal to this high. So we're still we haven't technically broken structure, because breaking structure would have continued up higher. We're kind of at a ceiling right now. And then price starts to come down, and then it continues. So this high would have been lower than that one. All of this right here in the middle would be considered consolidation, because price is not Price is not going up or down. It's kind of just stagnant. It's actually, see, this is a channel. It's chilling between this channel. So I can put a buy in here, sell out right there, put another sell right here, cash out right there, put a buy right here, cash out, sell, cash out, and you ride this channel basically where it stays in this point. So here, here, so it just stays in this range. Granted, it only did it twice on the ceiling. Well, it did it 3 times on the ceiling, this little one. And then it did it once. So I wouldn't have known that it was a channel until it actually already happened. Like I said, 2 points creates, 3 confirms. In this case, we have 1, 2. So that's your creation, which, I mean, this little one doesn't really count as a all the way down. So it doesn't really count as a channel, to be honest. I'm not really counting the second one. So it'd be 1 and 2 is more solid. So there's your creation, and then 1, and here's your second one. But on the second one, it came back down. So it started to create the channel, but there was no confirmation. It just broke out after that, and then continued downwards. And then it hit a bottom, and then now it's on its way up. So that's support, resistance, and trend. Okay, those are the 3 basics to trading. You have to know, no matter what strategy you're using, whether it's the bounce back, whether it's the you're using indicators like the fast indicator in IML, or that some IML people are using, whether you're doing Fibonacci sequence, pattern trading, no matter what you're doing, you always want to do support, resistance, and trend to get a basic idea. Okay, so we did this on the daily. Okay, now if we want to do a trade that's a couple hours long, from the daily we're going to go down from there and do it again. So this is going to give you an hour's worth of time frame, but in this hour, normally when this price is moving up and down, it's going to be going up and down for a while until the hour's over. Okay, so as it's going up and down, I can make smaller buys and sells in that hour. Okay, in this case, it's a day. So each candle is a day's worth. So during this 24 hours, it's going to be going up and down. So from here, we're going to go down to, like, say, the hour. Okay, so now we're in the hour. So you can see January 19th, 12 o'clock to oh wait, no, that's 2019, my bad. So we'll say January 9th to 16th. So that's 7 days right there. So you can see how much movement it does in 7 days, where it went up, down, here's your up, here's a big down, and these are big movements. So we're talking, what, 139, 830 to 139.14. So it's 70 pips right there of a movement. Okay, so that's pretty steep. And this is what, from January 14th, 1500 to January 14th, 2200. So 7 hours. Well, we can count the candles too. 1, 2, 3, 4, 5, 6, 7. 7 hours. For 7 hours, 80 pips. Okay, so when you're looking at price analysis, if we're doing a shorter trade, then we're looking at the daily. November, January. 4, what was it? 7, 9 through 16, basically right here. So right now we're looking at an uptrend. Okay, so because what it's doing is it's going up to the line, and it actually already reversed. So we're looking at an uptrend. So this is why you do it on the daily first. You look and see what the daily is doing, and this is going to be your trend, and then you know how to trade on the smaller time frame. So in this case, since we're going upwards and we already broke past this top part, or this top line of the ceiling, then we know that we're trending upwards. So when we go to the 1 hour, we're going to do all the buys. So in this case, we'll do this buy. We'll do that one, that one, that one, this one. You do all those because you can see that the buys are significantly bigger than the sells because we're trending upwards. So as that's happening, you're going to continue to do those. So I mean, this movement here, this is January 4th at 1 a.m. And then if I put a buy in here, actually almost right away. This is January 4th, 1900. So that's what, 7 p.m. So from 1 a.m. to 7 p.m. it does 135, 922 to 138, 280. So 230 pips. And what, like 12, 16 hours, 230 pips in 16 hours, more or less. So I'm not using a calculator. I just did the math in my head, so I don't know if that's right or wrong. It's 4 in the morning. But yeah, so that's, you want to write that up versus like say this down, for example, or this down. It's very tiny. This down, or that one, or that one, compared to these big jumps. Or that big jump. I mean, this is a big down right here. We can consider that one a big down. That's what, 140 to 137. And it actually, if you see this wick, let me see if I can. On this candle right here, you can see that the line went down here. So technically, price even after this candle closed, when this candle opened, it fluctuated all the way to the point where it hit down here and then went back up. That's pretty much what I was going to go over today. I don't have too much for you guys. This is just the basics. I don't really want to overwhelm anybody with information. I'll do more videos later about like we can go into pattern trading and Fibonacci and more intricate price action type stuff. Like these candles, for example, where there's more wick than there is body, those are undecided candles. Basically, those kind of indicate where a reversal is going to happen, versus like these candles where there's more body than there is wick. These are just regular candles, whether it's a bearish or a bullish candle, bearish being down, bullish being up. These candles are undecided. This is basically where both buyers and sellers are pushing at the exact same pressure, I guess we could say, or the same, like there's the same amount of buyers as there are sellers, so the price literally doesn't go anywhere. It stays the same during the entire time frame. What it'll do is it'll fluctuate, but it'll eventually just break even and then jump over to the next candle. So usually when you see a candle down and then it jumps over to the next one and it's like this, then your next candle will usually be an up candle. Yeah, see, there's your ridiculously long. So there was two, in this case, there was two undecideds, and then your big reversal. And that's pretty accurate. I mean, it's not 100%. Obviously, nothing's 100%, but it's pretty accurate most of the time. Like here's your down, and then your undecided, and then your big jump. And then there's your downwards, undecided, up. This one's like a baby one, up, undecided, down. This is hit a peak, there's an undecided, down, undecided, undecided, up. This is down, undecided, up, undecided, undecided, down. Well, this progressively went down, but these were also undecideds. Whenever there's more line than there is body. Like here, these are all can be kind of considered undecided. I mean, the wicks are super huge, but you can see ultimately it's still trended down. That it's not 100%. It's definitely not. But it's more or less. I mean, there's a big one right there. This was coming down, so then it tried to go down, but it didn't even get close to this ending, and then it reversed. I like this one where it's coming down. There's your undecided, but it continued down. Sometimes there's surges like that where like price kind of like, say buyers and sell, like right now sellers control the market because it's going down. Say there was a surge in buyers where they tried to push the price up, but ultimately sellers still won and it continued downwards. Same here. There was a surge of, there's a bunch of buyers controlling the market, a surge of sellers for a moment, but ultimately buyers won. But yeah, I'm gonna wrap this up here. If you guys have any questions, just shoot me a message. Reach out on Facebook. My inbox is always open. Reach out to Jen, or whoever is your team lead, or whoever's above you, or yeah, just ask. I am here for any assistance that you guys need. Have a good one. Bye.